Welcome to this explainer. If you're looking for the absolute real winners of the massive AI boom, you might actually be looking in the wrong place entirely. Today, we're taking a deep dive into Quanta Services, ticker symbol PWR. We're going to unpack exactly how this $93 billion powerhouse has quietly positioned itself right at the very heart of modern infrastructure. We hear all this talk about the software and the incredibly fast chips powering our future, right? But somebody actually has to build the physical grid that makes all of that possible. And that is exactly where Quanta steps in.
Okay, let's dive into this. The artificial intelligence revolution. It's no longer just some abstract concept. As of August 2026, it is a massive, tangible consumer of actual physical power. AI data centers are generating literally unprecedented electricity demand. The existing infrastructure, it simply cannot handle it without major upgrades. So Quanta Services is stepping up to capture this massive demand. They're out there building and modernizing the critical electric power transmission networks required to keep these hyperscale data centers humming. But as you'll see, this incredible growth story comes with a highly debated valuation.
Part 1. A record-breaking quarter.
To really understand the sheer momentum behind this company, we have to look at their jaw-dropping Q2 2026 earnings report that completely stunned the market back on July 30th. Just look at this growth. Quanta executed flawlessly. They brought in a record-breaking $9.56 billion in revenue. That's a massive 41% increase year over year. Adjusted diluted earnings per share, that came in at $4.24, up 71%. And net income basically doubled, surging 97% to over $451 million. What we're looking at here isn't just a good quarter. This represents their 8th consecutive earnings surprise. They beat consensus estimates by a full 95 cents per share.
Now, let's talk about scale, because the number we're looking at here is absolutely wild. This is their total backlog, a record high $53.4 billion. And this isn't just theoretical future money floating out in the ether. Roughly $32.3 billion of this backlog is expected to convert into actual hard revenue within just the next 12 months. That gives Quanta incredible near-term revenue visibility, while that remaining balance preserves the kind of multi-year growth predictability that most companies can literally only dream of.
So, because of this massive outperformance and the accelerating organic growth they're seeing right now, Quanta did what any confident management team would do. They significantly raised their full-year guidance across the board. They bumped up their revenue expectations to a midpoint of about $39.5 billion. But even more impressively, they boosted their full-year adjusted EPS guidance by roughly 20%, targeting between $16.45 and $16.95.
Part 2. Expanding the Empire.
Now, Quanta isn't just sitting back and relying purely on organic growth. Oh no, they are aggressively using their capital to expand their geographical footprint and their specialized workforce. During the second quarter and into July of 2026, Quanta completed 4 highly strategic acquisitions: Phalcon, Enerfab, Percheron, and PSD. These are not just bolt-on afterthoughts. These moves added approximately 7,400 skilled employees to Quanta's roster, really deepening their electrical, mechanical, and engineering capabilities in key U.S. markets and Australia. Collectively, these 4 businesses are expected to contribute up to $1.4 billion in revenue for the full year.
The crucial point of all this expansion is really captured perfectly by Quanta's CEO, Duke Austin. He noted that these acquisitions solidify Quanta's position as the partner of choice for customers building and modernizing critical infrastructure. And that, right there, is the core strategy. As project sizes grow to accommodate AI and grid modernization, execution track records matter more than ever. Quanta is cementing itself as the undeniable, indispensable partner.
So how is Wall Street digesting all of this? With overwhelming, almost euphoric optimism. Out of 30 analysts covering the stock, we see 23 giving it a strong buy rating, with 6 holds and only a single sell. The consensus is an undeniable buy, with the average price target sitting right around $770, which implies some very healthy upside from current levels.
Let's break down a few of the specific heavy hitters here. Truist Securities slapped a massive $976 price target on the stock, citing the raised guidance. Jefferies raised their target to $833, specifically highlighting what they call execution scarcity in the sector and projecting a compound annual growth rate of roughly 16% all the way through 2030. KeyBanc chimed in as well with an overweight rating and an $807 target. The professional investor class is clearly fully bought into this long-term vision.
Part 3. The Valuation Dilemma.
Now, what's really interesting about this slide is the reality check it forces on us. By late August, Quanta stock had gained a staggering 46% year-to-date and over 60% over the past year, recently trading around $616. It's an undeniably exceptional growth story for sure, but as investors, we always have to step back and ask, at what price? Are we looking at a stock that is priced for absolute perfection and has fundamentally outpaced its own intrinsic value? Let's switch gears and objectively look at this valuation dilemma.
We're going to impartially weigh the scales here. On the one hand, the bull case is rock solid, right? A $53.4 billion backlog, 55% projected EPS growth for fiscal year 2026, and perfect positioning at the intersection of AI and grid modernization. But on the other hand, the bear case is flashing some serious warning signs. We're talking a sky-high premium price-to-earnings ratio, metrics suggesting the stock is 30% overvalued, and elevated volatility highlighted by a recent 14.6% pullback from its 52-week high of $788. To ground this bear case a bit, we need to quickly define the framework we're using. One major concern comes from a metric called GF value. This is a proprietary calculation developed by Guru Focus that estimates a stock's intrinsic fair value. It doesn't just look at today's price tag. It blends historical multiples, past business growth, and future forecasts to figure out what the business is actually fundamentally worth. And according to that GF value metric, the intrinsic fair value of Quanta Services sits at exactly $474.19. When you compare that to the trading price of roughly $616, the math suggests the stock is approximately 30% overvalued. So if you're a value-oriented investor, this indicates a very, very limited margin of safety.
The stretched valuation multiples paint a super similar picture. Quanta's trailing price-to-earnings ratio is sitting up at 70.7 times earnings. That is a full 41% above the company's own 5-year historical median PE of 50. And it's not just retail investors worrying about this. Major institutions are taking note. Actually, JP Morgan recently downgraded the stock from overweight to neutral, specifically citing these exact valuation concerns.
But honestly, perhaps the absolute starkest signal for the bears is coming from inside the house. Get this, over the past 12 months, company insiders have sold off $137.5 million worth of Quanta stock. And the amount of insider buying during that same period? Zero. Zilch, absolutely none. While executives sell stock for a million different reasons, a complete lack of buying activity at these price levels is a notable red flag that lots of investors monitor very closely. Furthermore, if we dig into the balance sheet, there are a couple of secondary cautionary metrics to be aware of. Despite the massive surge in revenue, Quanta's free cash flow actually declined by 21.38% in Q2 2026. Plus, their quick ratio, which is a measure of their ability to cover short-term liabilities, currently sits at 0.98. Because this is just a hair below 1.0, it suggests a slight tightness in short-term liquidity. Now, none of this means the sky is falling, but they are vital data points when you're assessing a stock that's essentially priced for perfection.
Part 4. Weighing risk and reward. And this brilliantly illustrates the macro picture we are looking at. We have a phenomenal business with flawless execution on one side and stretched valuations with insiders selling on the other. But zoom out, and you see the massive secular tailwinds filling Quanta's sails. 1. AI data center demand requires hyperscaled power infrastructure. 2. Aging grid modernization is forcing utilities to spend billions to upgrade their networks. And 3. The ongoing renewable energy transition requires vast new interconnection infrastructure. These megatrends are exactly why Quanta targets $46.6 billion in revenue by 2029. We're already seeing this materialize, with massive multi-year opportunities like the 765 kilovolt transmission lines currently being built out in Texas. Quanta is the exact partner executing these projects.
Which brings us to our final thought. The bottom line is that Quanta Services is sitting at the very center of probably the most important infrastructure upgrade cycle of our lifetime. The business is strong, the growth trajectory is incredibly robust, and the execution is undeniably stellar. But that valuation demands a premium price, leaving very little room for error. So the question for you to ponder is this: how do you balance an exceptional, industry-leading business against a severely stretched valuation? Are you buying exceptional fundamentals or avoiding a premium price? What are your next move?